Hello, I'm Jamie and welcome to my bookkeeping corner of the internet. So I wanted to talk to you today about paying yourself as a self-employed person and the logistics and the paperwork behind that, because I feel like there's a lot of misunderstanding in how this works and when we need to file T4s and T5s and that type of stuff. So let's get into it. The first thing to think about when you are paying yourself and to figure out whether you need a T4 or a T5 is to understand what type of business structure that you have. So if you're a sole proprietorship, that means that you have not incorporated your business, or if you're a partnership that's not incorporated, you would have a different considerations rather than if you were incorporated. So first I'm going to talk about those non-incorporated businesses. And if you're like, I don't know if I'm a sole proprietorship, if you don't know, you probably are, because otherwise you would have had to take steps to incorporate your business. So for my sole proprietorship friends out there, and for my partnership, non-incorporated partnership friends out there, you don't issue T4s or T5s for yourself. So when you pay yourself, essentially you don't really have the act of paying yourself. So you might pay yourself because you're transferring money from your business account to your personal account, and that's you paying yourself in your business. But the reality is that actually in CRA's eyes, they see whatever money you collected in the calendar year minus all of your write-offs and business expenses is how much you got paid. So say you billed $50,000 to your clients in 2021, and then you had $20,000 of expenses that you wrote off in 2021, then the CRA looks at that and says, okay, you paid yourself 50,000 minus your write-offs 20,000. Okay, you paid yourself 30,000, and we're going to tax you personally on that $30,000 of income. So there is no T4 slip, there's no T5 slip. Really, at this point, whatever money you took in minus your expenses is what you're going to be taxed on, and you file that on your personal tax return. So on your personal tax return, there's a statement of business activity, and that's what your accountant would be filling out with all of that information to say how much money you made in the year, effectively how much money you paid yourself. And then let's talk about the incorporated businesses. So for my incorporated businesses, actually, wait, before I jump over there, I forgot to mention for partnerships, it's the same thing, except however you split the income, however you split the income between you and the partners goes on each of your individual tax return if you're not incorporated. Then if you are incorporated, this is how it works. So this is where you want to be extra careful, because CRA really doesn't like when you file payroll things and T4s and T5s late. They're really intense with their penalties on those. So let's get into it. So when you have an incorporated business, you own a corporation and you're the shareholder of the corporation, you can pay yourself in two different ways. One is via salary and two is via dividends. And a lot of times in the first few years of business, people will pay themselves dividends because it's not from a tax standpoint, but from a logistics standpoint, it adds a little bit of flexibility in how you pay yourself, in case you're not able to set up payroll and have the same amount coming out every month, because maybe your cash flow is a little bit like this, and maybe you're investing in your business some months and taking money back out some months. So usually people default to paying themselves dividends for the first little bit if their cash flow is not 100% clear and they don't have a set amount of salary that they want to pay themselves. So what a dividend is it's money that is paid out to the owner or owners of the corporation, declared as dividends. So you have to tell the CRA it was a dividend after the taxes are filed and after all the expenses are claimed. So in the sole proprietorship example I gave you with the 50,000 minus the 20,000 in expenses equals the 30,000 of what the sole proprietor is getting taxed on. So as a corporation, it's the same thing. They would be taxed on that 30,000. They would take that, they would pay the tax out of that 30,000. And then what was left, however much, maybe let's just say like 25,000, then that at the end of the day, they could be like, okay, I gave this to the owner, or I gave this much to each owner. So dividends are really like the payout of profit after everything else has been paid out from the business. It's like what's left over in the pot gets to be paid out to the owners. And they're declared after, usually after the tax filing is done and after you know kind of like what happened in the year. So an owner of a corporation could be like taking money out throughout the year, and then at the end of the year they meet with their accountant and they're like, okay, I'm going to declare this much of this was dividends. So it's kind of like funny because in theory it's what's paid out after everything's said and done, but in practice it usually is a more like a decision that's made at the end of the year based on how much money you just so happen to take out of the business throughout the year. So dividends. So when you pay yourself via dividends, then you have to issue what's called a T5 slip. And that slip is a slip that tells the CRA how much money you took out of the business in dividends, because you got to get taxed personally on those dividends. CRA wants to know when you took money out of your corporation. So if you are paying yourself in dividends, and if you don't know, you're probably paying yourself in dividends because you would have known if you set up a payroll structure, which we'll get to in a minute, then the last day of February is when you need to issue that T5 slip. So you need to go to your accountant and tell them how much money you took out in the previous year, or you guys discuss how much you're going to claim as a dividend from the previous year, and then issue that T5 slip by the end of February. And that's basically how it works for dividends. So just to recap, it's cash paid out of like what's left in the pot. And usually for small business owners, it happens on like you kind of take money out throughout the year and then you declare it come tax time after you've discussed with your accountant. And that is where you would make sure to get your accountant to issue that T5 information slip to tell the government how much money you took out of your corp. And then you take that T5 and you use that to file your personal taxes. So the last one is salary. Salary is something that I think most people are used to the concept of salary. And so when you own a corporation, you can choose to pay yourself with a salary instead of dividends, or you could even pay yourself with a mix of salary and dividends. And so how it works for salary is you would set up a payroll account with CRA, just like you would have set up like an HST account. You set up a payroll that's a different tax filing account. And then once you have somebody yourself on payroll, you're paying yourself on a regular basis, you know, monthly, weekly, bi-weekly, whatever you've decided with your payroll software. And then you're making sure that when you're paying yourself out, you're deducting the appropriate CPP premiums and federal taxes and provincial taxes, which is all done within your payroll software. So don't ever recommend people to do payroll manually. You get on a software, or you get your bookkeeper or accountant to do it. So when you're paying yourself via salary as the owner of a corporation, and paying other people, then what happens is at the end of the year, you need to report to the CRA, just like with the T5, you need to report to the CRA how much money you paid yourself in salary in the year, and how much taxes you deducted off that salary, how much CPP you paid on behalf of your corporation, paid on behalf of you, how much deductions, like all that stuff goes on this information slip, which is your T4. So the T4 slip is T4 gets filed in the last day of February, just like the dividend slip, the T5 slip. And there is one thing that differentiates the T4 and the T5, like, is that when you do, well, no, there's many things that differentiate them, but one that I want to talk about is that when you file your T4 at the end of the year for a corporation, sometimes you may have taken off too much tax or too little tax, or if it's your first year and you messed a few things up, sometimes there's like an amount to pay or amount to claim back. So whereas with the T5, it's just an information slip saying this is how much it was, good to go. Because when you're on salary, there are more complex things like deductions and CPP and all that. At the end of the year, what happens is you file the T4 in order to report everything and also to make sure that the right amounts were deducted and sent back to the CRA. So it's kind of also like a reconciliation of all of like your payroll remittances that went out. And then what happens, you give yourself that T4 from the corporation, and then you personally take that T4 and file your personal taxes. So with salary, the nice thing about salary is it is a deduction. So in my example where I said, okay, the business made $50,000 in sales in the year and had $20,000 in expenses and 30,000 is left. When you pay yourself salary from your corporation, then that salary gets deducted in that 20,000 of deductions that I talked about. So the salary is a write-off for the business. Whereas with dividends, the dividend is not a write-off for the business. The dividend is paid out after all the write-offs, after the tax and everything like that. Think of it as like what's left in the end of the pot, at the end of the pot. And then salary is like, it goes into that 20,000 bucket of deductions and reduces the amount of tax the corporation pays. So was a lot of information, but needless to say, if you are a sole proprietorship, you do not need to file anything for any sort of like T4s or T5s. You could just go ahead with your regular personal tax filing come April this year. And if you are a corporation, then you may have to either issue a T5 slip or a T4 slip as for the last day of February. So we talk about all this type of stuff in Bookkeeping Bootcamp, my signature program, where I teach business owners how to master their bookkeeping. And in one of the phases, I actually go more in depth into how these things work. And we work on, estimating the amounts you're going to have to pay for taxes and making sure you're super clear on the calendar of like what you have to pay and when, because things start to get complex when you have dividends and you're like, what dividends am I going to declare? How much is my personal tax bill going to be? So we go into all of this in Bookkeeping Bootcamp. So make sure to get yourself on the wait list if you are looking to wrap up your books and take more control of your finances. And that's it for today. Hope you learned a thing or two. Bye.